All attendees are in listen-only mode.
Hi everyone, and welcome to our webinar, The End of the Bull Market, How Turmoil in Global Bond Markets Could Affect Australian Equities. I'll just get the cotton wool out of my mouth and I'll be able to speak properly. I'm Debbie Phillips and I'll be convening the webinar today. It will, of course, be presented by our very own Neill Colledge. But before I do the introductions and hand over to Neill, I'll just go over a few quick housekeeping things because we're just waiting for a few of the last couple of registrants to come online. At the end of the webinar, we'll be opening up the floor to questions. You can ask a question at any time throughout the webinar by typing it into the question box, which is in the user panel that you'll have noticed. It generally pops up on the right-hand side of your screen. So anytime you think of a question, please feel free to type it into the question box. Once the presentation itself is over, I'll ask Neill the questions that you've asked in the order that they are presented to me. Time permitting, we hope to be able to answer all of your questions, but if not, we'll be able to answer any of your missed questions personally via email. You may have noticed a handout section in the user panel. Please feel free to click on the handout that's currently there and have a look. We'll also be adding a PDF version of this presentation to the handout panel at the end of the webinar. As I said, once the webinar presentation is finished, we'll be asking questions and we'll also let you know then that the PDF of this entire PowerPoint is up there ready for you to be able to download. So it looks like most of our attendees are here. So it's now my pleasure to introduce Neill Colledge, who's Millinium's Head of Australian Equities. Neill's one of Australia's best performing Australian equities fund managers. He draws from over 35 years of experience in using quantitative and qualitative methods to assess companies and industries. Neill managed QIC's Australian Equities Fund of up to $11 billion for 8 years, during which it outperformed the Australian market. Millinium's Australian Equities Fund has consistently been the #1 performing fund for 3-year and 5-year returns against all of its peers. So I now turn you over to our very own Australian Equities whisperer, Neill Colledge.
Good morning, everyone. I'm Neill Colledge, and I'm going to talk to you about how bond markets will affect Australian equities markets over the next 12 months or so. This is very much an equities manager's view of bonds. For the technical details of how bond markets work and what's actually happening, I refer you to Mark Phillips, who incidentally has run what is Australia's most successful bond fund for the last 1 year and the last 3 years. So this is an equities guy's view of bonds. What I'm going to tell you is basically about the next financial crisis. It's not going to be a rerun of the GFC. The GFC, if you recall, was something that originated in developed markets, mostly in housing and the banking system there, and it mostly affected the developed economies. This time round, the next crisis is going to impact emerging markets, but there will be spillovers for Australia. Now, most of these spillovers will happen at the level of financial markets. There will be some effects on the real economy, but mostly it's about financial markets, because it's the events in the economies of China, Japan, and the US which are the most important for the Australian economy. So today we're mostly talking about financial markets. The effects in the real economy will reduce global growth and hence commodity demand, and thus affect the Australian economy negatively. But in the financial markets, you are going to see quite a sharp correction, which will force the reappraisal and repricing of risk, and that will throw flow to all equity markets. And the single biggest takeaway from this is that Australian investors should stay defensive. First of all, let me remind you, those of you who aren't actually bond investors, just how big bond markets are. Bond markets globally are bigger than equities markets. They're bigger than GDP. They are very large indeed. There may be some amongst you who, like me, have very old self-managed super funds which actually had to own bonds 30 years ago, but most Australian investors don't own bonds. This is different. Most European and US investors do own bonds. Why are bonds important? Well, government bonds are the bedrock of finance. The government bond is usually taken as the risk-free rate. Corporate bonds have become more and more important in the US and Europe, not so much in Australia, where the issuance is mostly from the financial sector, but more and more in Europe there has been issuance by companies since the GFC, basically because your cost of debt is now at ultra-low levels, thanks to ultra-low interest rates, and most banks in Europe and the US have actually been deleveraging as they work their way out of their problems. Now, as I said, the GFC was essentially an event in the developed economies, principally in the US and Europe. What we think will happen is with the next credit crisis, there are a whole bunch of lower quality bonds out there, mostly in emerging markets, which are going to lead to bond defaults, and hence emerging markets will be the main victims this time round. Why is this important for Australia? Well, Australia, like Canada, is halfway between a developed and emerging. It is a developed country, developed economy, but it's also heavily dependent on commodity exports, and therefore when the emerging markets suffer, we are going to suffer some collateral damage as well. And by the by, interest rate cuts will not be much use in the next crisis simply because we have run out of room to cut interest rates. You can see just how far US Treasury yields have fallen in the last 30 years, how much LIBOR has fallen in the last 30 years. Basically, we're now down to zero. So, our context for analysing this is the macroeconomic trends which we've focused on and written about frequently for the last 12 months. First, that you have slower GDP growth in China, and that continues to be a factor, will continue to be a factor for the next 3 years. That's part policy, part structural. Secondly, you have the eventual rise in US interest rates. That has been a possibility for the last 12 months, ever since Bernanke made some injudicious remarks last June quarter and caused what was called the paper tantrum. Janet Yellen's being much, much more careful and foreshadowing it's definitely going to happen, but the markets don't quite believe her yet. And we have no idea really, and it doesn't matter for what we're saying today, whether it happens in September or December or early next year and so forth. On top of those two long-term trends, you had two big events last year. Oil prices collapsed, literally they halved, and they're still down. They were not about to bounce back. And the US dollar strengthened against almost all currencies in the world. We've noticed this in Australia because the A dollar has collapsed generally, but basically the US dollar went up against everything. These four factors lead to four different sorts of bond defaults. First of all, you can see what's already begun to happen in the US oil and gas sector. High-cost producers, highly leveraged companies defaulting on their bonds. They're restructuring their obligations basically because their cash flow has collapsed. Oil prices have halved and they simply cannot meet their obligations. You've also seen a rash of what we call covert defaults by second-ranked Chinese companies. This is a consequence of what's happening in the Chinese economy. And don't get me started on that because, as you know, it's one of my favourite subjects. We can talk about that for hours, but it's not today's subject. What you're seeing there is defaults by companies which don't matter. The big state-owned enterprises all have an implicit government guarantee. You've seen some near defaults by other companies which have been averted at the last minute because some arm of the Chinese government stepped in and arranged that someone would pick up the bill, someone would beat the interest rate, the interest coupons and so forth. But you've seen a couple of defaults, and this is going to happen only for companies which aren't politically important or systemically important. There's not going to be a Lehman moment in China, but you're going to have a string of smallish defaults. Thirdly, you're going to see defaults in low-quality government debt. This means places obviously like Greece, which has basically defaulted about 5 years ago. We're merely arguing about the outcome. Not just places like Ukraine and Venezuela and Argentina, which have effectively defaulted, but other places, which we'll come to later, which have been big issuers of debt at low rates since the GFC, and their economies really are not of sufficient quality to sustain this debt. Fourthly, and this is probably the most important area, ultra-low interest rates in the US have seen a surge since the GFC in US dollar denominated bonds issued by corporations which are domiciled outside the US. For those of you who can recall the 1980s in Australia, there was a little surge of Australian companies and individuals taking out debt in the form of US dollars and Swiss francs and other exotics because they offered ultra-low interest rates. We all know how that ended. The Australian dollar went down, the foreign currency went up, and the foreign currency borrowers found themselves a very long way short of meeting their obligations. That sort of thing has already started to happen in places like Brazil, and it's going to happen with a lot more companies which do not have significant US dollar revenues and cash flows, but have chosen to issue bonds in US dollars. We don't, by the way, expect any bounce back in oil prices, so we do expect that the oil sector's problems will continue. This, as we've emphasized before, is pretty much a rerun of what happened to the US oil sector in 1985-86, when the Saudis did exactly what they did last year. They cut oil prices by opening the pumps because they are tired of reducing their own production for the benefit of the rest of OPEC and US high-cost producers. That saw a rash of oil company insolvencies which flowed through to the banking system. This is not going to see, it's going to see the same oil company insolvencies for the high-cost producers. I mean, people like the oil majors are simply not at risk, but the high-cost producers, particularly of shale oil, will be at risk. It's not going to flow through to the banking system because basically the banking system hasn't been taking on much oil debt in the last few years. The oil producers in the US have been issuing bonds, and that's where the defaults are going to occur. So we think that the consequence of what we're saying, bond defaults, is going to add to the already negative outlook for emerging markets. Remember I said at the outset that during the GFC, emerging markets came out of it pretty well and so forth. This is not going to happen this time around. They're going to suffer. They've started to suffer already, and it's going to get worse. The fact of slower Chinese growth has already lowered most commodity prices, not just things which we know intimately, like the halving of iron ore prices, collapse of coal prices and so forth, but also the fall in soft commodities such as milk, just ask New Zealanders. What this means in all affected sectors is that the high-cost producers go out of business unless they can obtain some form of government subsidy, that the investment in these sectors falls, hence unemployment rises, GDP growth falls. This is happening right now in Australia, but it's also happening in a lot of other commodity exporting countries. And it can get worse. The current commodity prices are based on current levels of world growth, because when you have a certain level of GDP growth, that implies a certain level of commodity demand. If world growth slows for other reasons, then commodity prices can certainly fall further. For example, in last calendar year, the developed economies grew by 1.8% per year. The emerging economies, mostly China, but also other countries as well, grew by 4.6%, and that gave you an average world growth of 3.4%. The IMF is forecasting much the same for this year, based on a slowdown in the emerging countries to 4.3%, and an increase in the developed countries to 2.4%. Those figures are a little on the high side. Other forecasters are less optimistic. For example, the World Bank thinks that world growth in calendar 15 will only be 3.0%. And all that takes is things to be not quite as good as one would hope in the developed economies, particularly Europe, and worse than one had hoped in the emerging economies, like if China slows further. Now, this has all been pretty much anticipated by investors. It's been visible for the last 12 months. Actually, it's been visible for the last 2 years with commodities prices falling. But investors this year have begun to react. They have stopped investing in emerging markets. In fact, the current monthly inflows are about $4.2 billion at present, and that's only 20% of the average monthly inflows over the last 5 years. So that's the negative outlook is pretty much discounted, but it can get worse. In fact, it would be easy for the present low level of inflows to turn into actual outflows. This series of charts is really just to emphasize how falling exports cause falling growth. And here you can see in the first chart, export slump across emerging markets. Basically, it's been bad for all emerging markets. Your exports have been down pretty much no matter where you've been. Obviously worse in some places than others, but basically negative. You've had it exactly reflected in the next chart, which compares commodity exporters around the world, net commodity importers, which are basically the developed countries, with the odd exceptions of Australia and Canada, are the dark red line, which has been pretty stable even through the GFC, and it's holding up quite well. Commodity exporters, the emerging economies, suffered badly during the GFC, but bounced back very hard. But since then, it's been getting steadily worse, and retail sales growth is steadily dropping towards zero, and it will certainly reach that in many countries. The third chart, emerging market quarterly GDP, simply highlights what's happening. The emerging markets were doing very, very well in the early 2000s, post the Asian crisis. They were doing very well until the GFC. They went down, they bounced back, and since then, no. It hasn't been good, and it's getting worse. So now we start focusing on financial markets. I must emphasize when I talk about bond markets, we're not actually talking about investment grade bonds, i.e. BBB and better. We're not talking about developed countries, with the exception of Greece and a few other oddities, because default rates for investment grade bonds are consistently very low. They don't even get to 5% even during crises like the GFC. What we're talking about is bonds which are either unrated, or if rated, they're below investment grade. The usual term is junk bonds. These are always risky. The historical default rates in financial crises such as the GFC reach 15%, and a 15% loss of capital is spectacularly damaging for any bond investor. As I said earlier, the riskiest companies are those which borrow in US dollars when they don't have the natural hedge of cash flows in US dollars. And we've just seen last year how a single event, such as the low oil price, can make a whole industry riskier overnight. Not that it drives the whole industry into insolvency, but the highly leveraged companies and the high-cost producers will be the first to go. This chart, labelled "Most Bonds Are Very Safe," shows the expected issuance of government debt in 2015. Standard & Poor's forecasts that governments will issue about 6.7 trillion debt. This is pretty easy to forecast because it basically comes off their deficit financing needs. As you can see, most government debt comes from very safe countries, such as the US and China and so forth. It's only when you get down to much, much smaller issuers, such as, for example, Colombia and Turkey and South Africa and so forth, that you find that there might be problems. But these are actually a tiny part of the total issuance of government debt. The whole point of this chart is just to say, look, most government debt is actually perfectly safe. It is pretty much risk-free. The problems arise at the edges, where there has been a lot of government debt issued in the last few years, which is not sustainable in the long run. Why do we focus on debt defaults? Surely they're bad for the creditors, but no one else. Well, not exactly. When a government defaults on its bonds, as you may have noticed in Greece, and Greece is absolutely tiny. Greece is less than 2% of the EU's economy in terms of GDP. Greece basically never mattered very much. But government bond defaults affect GDP. First of all, they reduce the availability of credit in that particular country, and they do a very, very good job of frightening off investors, equity and bond investors, from anything else in that country. Obviously, in the last 5 years, very few people have been investing in Greece. Corporate bond defaults are actually in some ways more important. They obviously make the creditor's assets disappear in part. Secondly, they also tighten the credit availability because no one particularly wants to lend to similar countries and similar places. And of course, they provoke falls in share market prices. At present, if you look around global bond markets, you'd find the following 6 countries on pretty much everyone's bets for most likely to default, not necessarily at a government level, but certainly at a corporate level. That's Brazil, Colombia, Indonesia, Peru, South Africa, and Turkey, because these are the countries which have the least room to move in terms of government deficits as a percent of GDP, in terms of foreign exchange assets. I mean, obviously China, which has $4 trillion in foreign exchange reserves, can run for a very long time, but most of the countries on this list don't have it, and they have substantial borrowings in US dollars already. So that's at present our list of countries which are most affected. It doesn't directly affect Australia. None of those are Australia's major economic partners. What we're saying is this will flow through the financial markets. If you look at what we're talking about borrowing by emerging economies, the 2 pie charts there make it very clear what's happened. The first pie chart, labelled 2000 to 2007, relates to where the $37 trillion worth of borrowing in that period went to. Mostly it went to developed countries. More than 3/4 of it went to developed countries. Only 22% went to emerging economies. And in fact, as a footnote, you can see what the problem was with the developed countries, because when you look at what went to borrowing in developed countries, most of that, 34% of total borrowing, i.e. about $12 trillion, went to households. That was essentially the over-gearing of households in the US and Europe, gearing up to buy houses, etc., etc. And we know what happened to that one. Now, if you look at the next pie chart, labelled 2007 to 2014, you can see the total amount has gone up from $37 trillion to $49 trillion. But the really striking thing now is that emerging market borrowing is nearly half of the total. It's gone up from less than 1/4 to nearly half, and of that, half of the emerging market borrowing, 25% of the total, i.e. over $12 trillion, has gone to corporates in emerging markets. This is the risk we're pointing out, because as anyone who's been a banker or has analysed banks knows, when you have a sudden surge in lending to a particular sector or in a particular country, that will be followed a few years down the track by a surge in bad debts, because you take on risk that you shouldn't have taken on. So those 2 pie charts summarise exactly what's going to happen over the next few years. You're going to see problems with corporates in emerging markets. But next, at this point, I have to emphasise that we're talking about financial markets, not about the real economy, and this is where the handout on China and Australia comes in, that what we're talking about doesn't affect China, because China, as I said, is going to have a few defaults by corporates, but not very much, not enough to affect it. But what's happening in China, the move towards Silk Road investment, the decline of the Chinese stock market is not positive for Australia. But that's off the subject. We leave there as a handout basically because as a Chinese speaker, I can't resist talking about it. So now we get to the heart of the presentation, which is how contagion in financial markets works. You start with a single default. A company or country fails to pay just one coupon of one bond series. What that means is that a default in one bond sends a signal to bond fund managers that there is more risk there than they thought, and therefore they try and sell out of anything which looks similar. Similar in the sense it's the same industry, the same area, it's affected by similar factors. This creates a rush for the exit, just like shouting fire in a crowded theatre. Everyone wants to sell, but not all sell orders can be filled, because basically you end up with more sellers and no buyers. Nervous retail investors start trying to redeem their holdings in bond funds. Now, of course, the bond fund manager is faced with additional problems, redemptions, as well as whatever problems he has in his portfolio. He or she cannot actually sell the illiquid bonds, not just the defaulted bonds, but also the bonds which have gone seller, no buyer. So he has to sell the liquid bonds, the better quality, i.e. you sell whatever can be sold. And effectively, this is what contagion means. Selling pressure spreads to perfectly safe bonds, i.e. all bond prices tend to fall, volatility rises. What's going on here is a process of risk reassessment. When you have a bond default, which causes bond prices to fall, investors start looking for similar risk exposures in their portfolios, i.e. falling prices mean that risk is being repriced. Now, think about a fall in the price of any commodity, any company, any bond. It signals that maybe someone knows more about this than you do. Maybe someone considers these riskier than you do. So when you see, speaking from personal experience as a fund manager, when you see a price suddenly fall, you should think, oh, what happened there? Why did this fall? Is this a problem? And you begin to look around for reasons why this might have fallen, because you know very well that there is such a thing as insider trading. There are people who know more about you. So that's what contagion is. You start thinking, well, should I sell this, that, and the other thing? The incidental effects of contagion are that high volatility means that derivative protection is more expensive, but credit spreads will naturally expand because riskier bonds require high yields in order to trade. Term spreads may or may not expand. The consequence of risk reappraisal and repricing in bond markets flows pretty directly through to equities, usually with a lag, but obviously because equities rank behind bonds in a liquidation, if the price of the company's bonds have risen, then those bonds have been deemed riskier by the market, which means the equity in that company must be riskier. And the question for an equity fund manager there is to say, well, look, given these changes in bond prices, what does this mean for the different risks in the companies in my portfolio? And that's usually requires some time to assess, cannot be done overnight, and it's not about individual stocks. It's about, well, is this company more risky than that because its bond price, the price of its bonds just fell more? Should I be selling that? Clearly, if the risk-free rate rises, that can affect the pricing of all stocks, not just in your portfolio, but the whole investment universe. Probably more importantly is that a rise in the risk-free rate affects every single company's cost of debt and its weighted average cost of capital. And of course, changes in term spreads and credit spreads will affect companies differently according to how their debt is structured, what sort of debt they have, what maturities it has, etc., etc. Now, the key implication for this for Australia is that although the Australian bond market is absolutely tiny, and most of the issuers are the big four banks, global investors may well choose to downweight Australian dollar bonds, not so much because they can see they're riskier, but also because they can see that there are better opportunities elsewhere. We have been a very popular country since the GFC because we've perceived to come through it very well. That may not continue. The point of this chart is just to remind you that the resources boom is well and truly over. It is not coming back. It's going to end up just like any other resources boom. It's going to be worse than anyone expected at the time. As you can see from the chart, we are not back yet to pre-resources boom commodity prices. prices would have to fall at least another 30% for us to get back there. They may or may not do so. We're not actually forecasting that exactly where they're going to go. We're simply saying for the next few years, it is not going to get any better. For those of you who are in the market in the 90s, you'll recall there was no boom. There are a whole bunch of false alarms, people saying, yes, it's going to pick up, but there was no resources boom because resources prices stayed weak for more than a decade. That's what may be happening over the next few years, but either way, whether there's any recovery or not, it's not going to be fast. So that's why we hold up no hope whatsoever for the Australian resources sector. In fact, we think that the resources sector have another 30% to fall. I mean, BHP, Rio are not going to go bust. But with falling commodity prices, with an increased risk rating placed on Australia, there's no reason why they can't fall 30% or more. Australian banks, we've said it before, we think that they will fall another 20%. The Big Four are not going to go bust. They are very much protected species, but we have some of the most expensive banks in the world. They trade at 2 and 3 times their net asset backing, whereas most banks are whether they be in the US, China, Europe, are struggling to trade at 1 times net asset backing. The Australian banks, although they're perfectly good quality, they still have the possibility of falling by 20%. The other interest rate sensitive sectors are utilities and infrastructure, which we think could fall by 15% odd. That's mostly about what might happen in regulatory background in utilities and infrastructure. For example, there might be a change in the amount of profit which electricity utilities are about to make. Property trusts we think will fall by 15% simply because that's about the amount they are above their net tangible asset backing in terms of the underlying physical property. We don't think there's going to be a property crash, but we think, yep, there's maybe 15% downside there. Although this is a very negative view, so we're basically saying that more than half the market by market capitalisation is going to go down, we want to emphasise that there will be winners out of this. Just as companies which have strong European and US operations have done very well in the last couple of years, we think those will continue to do well. And as an incidental positive, over the last few years, because of the resources boom, the S&P ASX 200 has been quite heavily weighted to miners and so forth. Most of the little miners are getting smaller, so that they fall out of a 200, and they're being replaced by rather more stable companies, not dependent on commodities, and considerably more interesting from an investment point of view. So although we think the whole market is going to fall somewhat, we don't see this being a GFC-style crash, and we do think that there'll be winners out of this. Just in passing, we really want to emphasise that if you hold any gold, well, you've already lost half your money. Sell now before it gets worse. As you can see from the chart, what the expectations which were attached to gold at the time of the GFC have been spectacularly disappointed. There has been no sudden surge in inflation, and gold is still capable of falling a very, very long way before it gets back to any stable level. The chart here shows the gold price for the last 100 years, inflation adjusted. The actual peak gold price in 1980 was $800 an ounce. I can remember I was there at the time. That's about $2,000 in current Australian dollars. Sorry, in current US dollars. It can fall well back to where it was in the 1990s, 1960s and 70s and so forth before it reaches any sort of bottom. Gold is not a safe haven. So, what does the Australian investor do? Well, we've said for some time that at least a third of the portfolio should be outside Australia. Whether you do that by owning overseas stocks directly, by owning ETFs, or by owning Australian stocks which have big overseas operations such as CSL, is really up to you. But we expect Australian growth to slow down. And we expect the AUD to fall against not just the USD, but against most other currencies in the world. This is not a bet on the US dollar. Europe also serves quite nicely. It's basically a bet against the Australian dollar. As you'll have gathered from what we've said about emerging economies, we think that all Australian investors should stay away from them completely, and for the time being stick to developed countries, which is mostly US and Europe. And as an example, Millinium's US dollar denominated S&P 500 fund returned 29% last year compared to the benchmark's 26%. Only half of that was due to currency. The rest was basically due to the S&P 500 outperforming the S&P ASX 200. We think that there is a lot of potential in sectors with high value add, which are not all well represented in Australia, and would have to be obtained by owning the overseas stocks of the US or the ETFs. We put in a big plug for that cash, which is unpopular because your return at present in Australia is pitifully small, but we point out that Warren Buffett has about 1/6 of Berkshire Hathaway's assets in cash, a mere $60 billion, and in his latest annual letter, he points out the advantages of holding cash. Overall, we think it's a good time to stay defensive, and stay defensive until things get a lot worse. Particularly, we think that the signal for actually buying stuff will be the start of a recession in Australia. As you can see, stay defensive because things are only going to get worse. Thank you. I'm happy to take any questions.
Thanks so much, Neill. So can I assume that by that last slide you're expecting the end of the bull market to get as bloody and messy as any episode of Game of Thrones?
Oh, look, I fully expect White Walkers. It would be dangerous to go outside because it's going to get worse.
Awesome. Okay, we do have a couple of questions for you, but while you catch your breath, just so everybody knows, the End of the Bull Market final PDF has now been uploaded to the handout, so please feel free to click on that. It will open in your browser and you can, of course, download it to your hard drive for looking at later on. Also, we'll be emailing everybody with a link to the webinar recording tomorrow, and it will also be available via our website tomorrow at www.millinium.com.au/webinars with a capital W.php. I hope that was not too fast and everybody got that straight up. Okay, we do have a couple of questions. So the first one, Neill, is why do you expect interest rate sensitive stocks on the ASX to fall in price when Australian interest rates are not going up?
That's a good question. It's essentially because markets are made at the margin, i.e. it's a marginal buyer who sets prices. And in Australia, the marginal buyer is not the ordinary Australian institution or the retail investor. It's the overseas investor. Now, the overseas investor doesn't have to own Australia. They don't have assets or liabilities here. They can move around the world to much larger markets if they choose. I mean, if the Australian share market is only 2% of global market capitalisation compared to 40% plus for the US, for example, and if they can see that yields are better, that prices are better in another market, that is where they go. So although it matters to Australian investors where Australian interest rates are going, the choices of international investors are driven by other factors, particularly international interest rates, international assessments of risk, and so forth. If you remember what happened to the banks in the June quarter, that was essentially driven by foreign investors who didn't really care whether the fact that the banks were come dividend, because they can find better dividends somewhere else and they don't benefit from the franking credit. So it's the international investor who decides where prices end up in the Australian market.
Great, thanks for that, Neill. Now, we do actually have somebody who wants to ask you a question verbally, so I have turned the microphone on. There may be a slight delay in audio, but Damien, when you're ready, go ahead.
First of all, thanks, Neill. I thoroughly enjoyed that, as always. My question is there a direct link between Chinese bond defaults and a weakening in Australian iron ore exports to China?
That's a good question. There are in fact two links. One is that they come from the same source. Both Chinese bond defaults and falling iron ore prices arise from the fact that Chinese growth is slowing. Chinese economic growth last year at 7.4% was the lowest it's been since 1990. At the same time, you actually have deflation for producer prices in China. China's producers' prices have actually been falling for the last 3 years. Last year they were down by 4%. Consumer price inflation was just positive, a bit over 1%, but producer prices have been falling. The combination of slower economic growth and falling producer prices places a lot of pressure on companies. First of all, they try and sell whatever assets they have, and that, particularly for Chinese companies, meant liquidating excess inventories, such as iron ore, which they'd held as pipeline stocks, because holding inventories had done very well for them for a decade when commodity prices were rising. When commodity prices are falling, they're losing money, and they're motivated because of their own financial position to liquidate whatever assets they can. So essentially, that's why you get bond defaults and the fall in iron ore prices, because they come from the same source.
Okay, thanks for that, Neill. Sorry, Damien, I always mean to speak over the top of you. We have 3 more questions, and I think that's all the time that we'll have to actually physically answer. However, if you do have any more questions, please do feel free to type it in, and we'll be able to send you an email in reply. The next question, Neill, is from Peter, and he asks if the question is, will Australia inherit higher interest rates when USA increases their rates?
Not directly. Each country which has its own currency can obviously set its own interest rates. What an increase in US rates does is to put upward pressure on global interest rates, but it doesn't mean that every country has to immediately raise rates. Those countries which have their own currencies, for example, Australia and most of the world, excluding the Euro area, and currencies like China's renminbi, which is for policy reasons pretty much directly linked to the US dollar, they can go anywhere, and it is the currency which takes the strain of the change, not the interest rate. If we were linked to the US dollar, then yeah, there would be a fairly direct effect. But your question is well founded, and that's actually one of the reasons why we expect the AUD to keep on falling down to 60 cents, because we have slowing economic growth in Australia compared to economic growth in the US speeding up, and we have higher inflation.
Fantastic, thanks for that, Neill. Now, one of the questions, a question asked by William, and I do apologise if I don't know what these codes mean or if I'm meant to know the companies, but the question is, does that mean that companies such as WPL and STO that pay dividends are no-go zones in your way of thinking?
In my way of thinking, yes, they are, because the problem with companies dependent on commodity prices is always that they have no real control over their revenues. If, as in the case of both Woodside and Santos, you are low on the cost curve, you are going to survive, but that doesn't mean that you are going to have enough cash flow to maintain your dividends at present levels. We always recognise when we own something like that, and the portfolio did actually own Woodside for most of last year, that there is commodity risk, and that's why we took out Woodside-specific derivative protection, which served us very well, protected us against the fall. But essentially, the answer to that is yes. Anything in the resources sector is at risk, because all commodities tend to fall pretty much at the same time, and there's no reason why oil could not fall another $10.
Fantastic, Neill. Thank you very much. And at least I know what WPL stands for. I will have to have a look at what STO is later. Our very last question for this morning, and as I said, if you do have any other questions, do feel free to type it in because we will respond to you personally. The last question is, bond yields in the US and other developed countries have been falling for more than 30 years, partly because inflation has been falling. Are you saying that the long bull market in bonds is about to end?
Not quite. What we're saying is that there is going to be a period of disruption caused by bond defaults in lower quality bonds. That will actually have the short-term effect of pushing bond investors back to safe havens, such as US Treasuries, UK gilts, German bunds, etc., etc. Because they will have lost money or fear losing money in riskier bonds, they'll go back to the ultra-safe bonds. So what we're saying is that this may be a disruption to the long bull market in bonds, or it might be the beginning of the end for it. We don't know, but all we're talking about is the implication for Australian equities here, which is undeniably negative.
Fantastic. Thanks, Neill. And I'd like to thank you on behalf of everybody attending for your presentation today. I'm sure it offered a great deal of insight for everybody. I'd like to also thank everybody for attending. Please do, in the next few seconds, take advantage of downloading those handouts, the slide that Neill had earlier on in the presentation, as well as the full PDF of the PowerPoint. Do remember that we'll be sending you an email tomorrow with a link to the webinar recording, and you'll also be able to view it via our website, www.millinium.com.au/webinars, capital W.php. Thank you very much for attending. If you do have any questions, do feel free to email us and we'll pass it on to Neill, and we will see you at the next webinar. Thank you.